Welcome to the third chapter of the series Financial Education for Pilots. In the previous two chapters, we looked at the overall history as it relates to pay for pilots, as well as different tax deferral avenues that exist. This third chapter will focus on providing an overview of different passive income streams for pilots to make money in addition to what they make from their airline. This third chapter will look at different passive income streams available, making money from the stock market, the real estate market, and through side hustles. Before we dive in, the topic of risk needs to be covered. All forms of passive income will require risk. Although unlikely, there is still a chance that no matter what type of investment, stocks, real estate, side hustles, you could lose all your money. In addition to passive income, the question of time, specifically liquidity, is one of the more important questions when determining what investment you should make. Liquidity is essentially how quickly you can pull out cash from an investment if you need that money. For example, if you put money down toward a house, you are not very liquid, since it would take weeks to pull that money out, in addition to the fees and closing costs. If that money is in a checking account at your bank, you are very liquid, since that money is readily available should an emergency come up. Generally speaking, the more liquid an investment is, the lower the rate of return on an investment, or ROI, you will see. For example, a savings account currently provides a 0.5% yearly return. If you needed to pull that money out for whatever reason, generally the time for it to transfer to your checking account would be a few business days, which is relatively fast. Putting $100,000 in a savings account would net you a $500 return for that year. Let's compare that to the stock market. Historically, the overall market has provided a yearly average return of 10%. Putting that $100,000 in the market would net you a $10,000 return for that year, much higher than a savings account. However, the question of time comes back up. For example, in 2015, the stock market yielded a negative 0.73% return, meaning you would have had to wait significantly more than a year to see that $10,000 return, reducing the liquidity of your initial investment. When we talk about the overall market, most people are generally referring to the S&P 500 index. This index comprises of 500 different companies, some well-known like Tesla and some not so well-known, such as the AES Corporation. The S&P 500 reflects the overall market since it is made up of so many different companies in so many different sectors of the US. The other indexes referred to are the Dow Jones Industrial Average, which looks at 30 companies, and the NASDAQ Index, which is more focused on technology companies. There is a key distinction in investing versus trading in the stock market. Investing is the attempt to build wealth by holding onto assets over a significant period of time, usually years. Trading is just the opposite, usually entering and exiting positions from seconds to months. Let's take a look at the different types of trading. Scalping. This is entering and exiting a trade within seconds. Day trading is doing the process within the trading day. Swing trading consists of holding the asset from a few days to a few months, and position trader consists of holding the asset from a few months to a few years. Investing in the market can mean buying and selling various different assets. While the topic can go into extreme detail, here we will cover the brief assets one can buy and sell. Generally speaking, the different assets you can invest in while in the market are company-specific stock, bonds, commodities, mutual funds, and exchange-traded funds. Company-specific stock is essentially investing in a specific company. This does not always mean that if the company does well, the stock will also do well. Bonds are a fixed income instrument that represents a loan made by an investor to a borrower, typically corporate or governmental. There exist various different types of bonds that vary in length as well, such as the 10-year Treasury bond. Bonds are less volatile to the market than stocks, and as you get older and closer to retirement, it is suggested that you have more of your portfolio in bonds than stocks so that your investment pool does not fluctuate as much. Commodities are a basic good used in commerce that is interchangeable with other goods of the same type. Examples of commodities are oil, natural gas, beef, and gold. Generally speaking, when buying a commodity on the market, it means it usually is through mutual funds and exchange-traded funds that replicate the movement of that commodity. Mutual funds are a portfolio of stocks and/or bonds and can track certain indexes. These funds are managed by a company, such as Vanguard or BlackRock, and generally have a managing fee associated with it. By being a portfolio of stocks, mutual funds are less susceptible to one company having bad news and its associated stock tumbling. Vice versa, if a stock has great news and a huge return, the upside will be limited in a mutual fund. Exchange-traded funds, or ETFs, are similar in mutual funds in that they are a portfolio of stocks and or bonds. ETFs, though, are more cost effective because they do not have managing fees tied to them. It is important to understand that the stock market is a zero-sum game. There's a finite amount of stocks, albeit in the millions, each company can offer to individuals to buy and sell. When you buy a stock, you are buying from someone who is selling it. The same happens when you sell a stock. You are selling it to someone who wishes to buy into the stock. Stock prices go up because of the perceived value by everyone in the market of that stock. If there are more buyers than sellers, the price will go up until someone holding the stock wants to sell it. When stocks crash down, it simply means everyone wants to sell or get out, and no one is buying, making the overall perception of that stock or market a pessimistic one. Because of this nature of transactions, the market as a whole is a zero-sum game. With the advancements in technology, there are various ways that one can invest in the market, which is conducted through a brokerage. You must do your due diligence in picking out the right brokerage for you depending on different factors. Different brokerages will have different fees associated with placing trades and in what types of trades. Additionally, some will allow extended hours trading, which is outside the normal 9:30 a.m. to 4 p.m. hours that the market is open. Opening up an account will generally require just a social security number and only take a few minutes. Transferring money in will require a deposit of some sort, usually a transfer from one of your current checking accounts. Transfers usually take 3 to 5 business days to complete. When we talk about passive income streams, we have to talk about taxes as well, specifically short-term and long-term capital gains tax. Disclaimer, I am not a tax professional. Tax laws can change year by year. Consult a tax professional for your specific situation. There are many complexities regarding taxes, so we will cover just the basics. Capital gains tax are applied when you make profits from selling an asset, which can include businesses, land, cars, and stocks. The holding period, or how long you've held onto that particular asset, will determine whether you pay short-term or long-term taxes. The defining moment is the 1-year mark, meaning if your holding period of an asset is less than a year, you are subject to short-term capital gains tax. If your holding period is greater than a year, you will benefit from reduced taxes with long-term capital gains tax. The chart provided omits certain metrics in order to show the different tax rates by different income levels. In 2020, the short-term capital gains tax are essentially your effective tax rates plus a 7.5% fee. Short-term capital gains tax can end up being a significant amount. For example, if you were single and brought in $100,000 in the previous year and had short-term capital gains of $10,000, you would have to pay close to $3,100 in taxes on those gains alone. For long-term capital gains tax, the chart provided omits certain metrics. For the 2020 tax year, long-term capital gains tax are a bit friendlier, with the maximum being 20% and no additional fee. Let's take the same example as before. You had long-term capital gains of $10,000. You were single and brought in $100,000. You would be subject to a 15% tax, meaning you would owe roughly $1,500 as opposed to the $3,100 in short-term taxes. It is worth noting that taxes will be applied to your net gains for that year. If one of your stock investments ends up being a significant loss and you close out of that position, this will reduce the amount you are taxed by that loss, although certain limitations apply. See the Why Sale link below for more information. Overall, let's look at what you can expect if you are looking to make money from the stock market. According to Vantage Point, there is roughly a 4% success rate amongst day traders when looked at a multi-year period. While many people may be able to make profits here and there day trading, to do it consistently through swings in the market is extremely difficult. How much can you expect to make from day trading? That question is very complicated and has a lot of factors to consider. In order to day trade, the SEC requires that you have at least $25,000 in your account to execute multiple trades a day. Referencing Vantage Point again, if you have $30,000 in your trading account, you can expect to make $5,500 after fees and before taxes, which equates to about an 18% return. If you are more interested in having your money earn money over time through investing, the market will yield about a 10% return. So, if you start off with $10,000, you can expect on average to see $1,000 in the first year, and for that to grow exponentially if you do not take any money out. Making money through the stock market can be difficult and takes a lot of time and practice. Being persistent, knowing the risks, and what to expect can alleviate a lot of headaches when you first start off.